We are continuing our CVP calculations for our Johnny's Manufacturing dataset. We are going to complete items 10 through 14, but before we do, we need to remind ourselves of some of the results of the calculations in our last video because we are going to need those calculations in order to continue on with computations for this video. In our first video, we calculated that total contribution margin when we sell 130,000 units is $325,000. And in our second video, we calculated our break-even units and our break-even dollars. Our break-even units is 116,040 units, and our break-even dollars, sales revenue, is 2,320,800. If you have questions about how these figures were computed, please go back to video number 2 for the break-even calculations and video number 1 for the contribution margin calculation. Let's look at item 10, operating leverage. The equation for operating leverage is total dollars of contribution margin divided by total dollars of operating income. And in this item, we are using 130,000 units as the volume of units sold. In video 1, we have already calculated that total contribution margin is 325,000 when we sell 130,000 units. So that's going to be our numerator. But we don't know the operating income at this level of units, so we need to calculate it using our shortcut equation for operating income. Contribution margin minus fixed costs equals operating income. So we'll take that contribution margin of 325,000 and subtract the total fixed costs of 290,100. And that gives us operating income of 34,900. Now we're ready to compute operating leverage by dividing contribution margin by operating income, and we get our operating leverage of 9.31. I have rounded that to 2 decimal places. But what is operating leverage? Operating leverage is a multiple. It is not a dollar amount. It is a multiple that tells us how much operating income changes when the sales volume changes. So the reason we calculate operating leverage is so that we can make calculations like our next step, number 11, where we are trying to figure out what happens to operating income when sales volume increases by a given percentage. So we have calculated our leverage multiple at 9.31. To figure out what happens to operating income when sales volume increases by 7%, we will simply take our leverage multiple, 9.31, and multiply it by our change in sales, 7%. When we do that multiplication, we get 65.2%. So, because we calculated our leverage multiple, we can quickly determine that a 7% increase in sales will increase our operating income by 65.2%. It's time to move on to item 12, the margin of safety in dollars. So before we can calculate margin of safety in dollars, we need to refresh our memories on what the break-even sales in dollars amount was. And we can see it's 2,320,000. The formula for margin of safety is the current amount of sales dollars subtract the break-even sales dollars. So the first thing we have to do is solve for the total sales dollars at our given number of units. And in our data set, it says that our monthly volume in units is 130,000. So to calculate our monthly sales revenue, we're going to take 130,000 units and multiply it by our sales price, which is $20 per unit. Multiply those together and get our revenue of $2,600,000. Now that we have solved for our current sales revenue, we can simply subtract the break-even that we calculated in the last video, and the difference is our margin of safety, which calculates to 279,200. The margin of safety is kind of like a buffer. We've calculated that Johnny's Manufacturing could lose $279,200 of revenue and still be breaking even. Margin of safety can also be expressed as a number of units by which a company is exceeding its break-even units. So to calculate margin of safety in units, we take the current level of unit sales and subtract the break-even units. The difference is the margin of safety. So we will take 130,000 units, which is our regular monthly sales volume, and we will rely on our previous calculation that the break-even units is 160,040, and take the difference and arrive at our margin of safety in units of 13,960. This calculation is telling us the number of units by which Johnny's Manufacturing is exceeded the amount that it needs to simply break even. Now we are ready for our final calculation in this video. We're going to express the margin of safety as a percentage of sales revenue. There are two different ways to calculate this. Either one will get you to the same answer, so I will show you both methods. The first method is to take the margin of safety in dollars and divide it by the sales revenue dollars. The second way is to take the margin of safety in units and divide by the sales revenue units. First, let's look at the dollar amounts. We calculated margin of safety in dollars up above here to be $279,200. So we'll put that for our numerator and 2,600,000 as our denominator. Remember, 2,600,000 is our current sales revenue at 130,000 units. When we divide that, we get 10.7% as our margin of safety as a percentage of sales dollars. Now let's look at the unit figures. So we will take our margin of safety in units, which we just calculated to be 13,960, and divide by our current level of sales units, which is the 130,000. So we do that division and we get the same answer of 10.7%. So you can calculate the margin of safety as a percent of revenue dollars or as a percent of units. Either way, you will come up with the same margin of safety percentage compared to revenue. And that concludes our third set of calculations for our CVP practice.